I have with me Dr. Stephen Enticott. He's from the CIA Tax Group, and we're going to be talking about how to use your self-managed super fund to buy property. Dr. Steve, welcome to Dollars with Sense again.
Hey, thanks for having us back, Dallas. Always fun.
Now, self-managed super fund to start with. What is a self-managed super fund?
Yeah, look, a super fund is no different to, a self-managed super fund is no different to a normal super fund or a managed super fund, except that the self-managed, i.e. self-managed super fund, is where you actually manage it yourself. So you're in control of your own destiny, your own investments.
So how do I go about starting a self-managed super fund if I don't have one?
Yeah, look, you generally speak to your financial planner or to your accountant who will normally set one up for you and do the audit and the compliance work for you every year.
Now, when you say the accountant or the financial planner,
yep,
what type of accountant would you have to be to give advice for a super fund?
Yeah, look, accountants can give fairly general advice on structures and how to set them all up, but if you want someone to tell you how to invest and what to invest in, well, then you do need to speak to a financial advisor or someone like myself who's both a financial advisor and an accountant.
So they're two different people?
Correct, yeah. Two different hats.
Okay, so what do we do from there then?
Okay, once you've decided that you want to set up a self-managed super fund, and the topic for this show is using your super in a self-managed super fund to borrow to buy a property. You normally establish it. That takes about a month for the ATO to give all the numbers, the ABN and the regulated status through. You would then apply to your managed funds to have your funds rolled out of there into your own self-managed super fund, and normally you'd create a cash management bank account where you would put the money into initially. Bit of a caveat, when you're if you're coming out of a lot of managed super funds, be a little bit careful there. Sometimes you've got insurance in those products as well, and once you close them down, if you've got a little bit older, or if you've had a major health issue, you may end up not being able to get insurance again. So in some cases, people leave a few $1,000s there to leave the insurance active and roll the bulk of the funds off into a self-managed super fund.
So what you're saying is that they would take their money out of, or most of their money out of their existing fund,
yep,
leave a few $1,000s or whatever the case may be in it, so that they can keep their insurances active,
yep,
and then they would set up a second self-managed super fund.
Correct, and that's called, let's say the Dallas super fund. So now Dallas has got a whole bunch of money sitting in there because he's been very diligent with his superannuation contributions over the years. That pool of money then, it still can't be touched. It is a normal super fund. It is highly illegal, and that'll be the topic for another show, I'm sure, about non-complying super funds. You have to treat this seriously. It is your money, and you can invest it however you like, as long as it fits in with the rules of superannuation. You can't touch it and all those sorts of things. It's your super fund money, and you're responsible for investing it.
How much do I need in a self-managed super fund to start with, or
yeah,
in a normal fund, and I transfer it over to a self-managed super fund? How much do I need to start with? Oh,
look, I've heard varying people say from nothing to 200,000. A general rule's 100,000. It really does depend on what you want to do with it. The important thing is you can actually have up to 4 members, so it doesn't necessarily mean you've got 100,000. It might be your wife and yourself, or your partner and yourself, who've got 50,000 each. And that's pulled together, and then you've got your 100,000 there. Look, 100,000 is a good rule of thumb. A little bit less if you're looking at a high gearing strategy is fine. Certainly, once you get below 50,000, it's probably not worth it. But again, depending on what you want to do, need to do the numbers.
How much is it going to cost me to set one up?
Yeah, set them up's cheap. Usually, $500 to $600 to establish a super fund. Look, one of the real benefits of self-managed super fund is it's cheap. They're cheap to run. If you look at the average managed fund with that $100,000 in there, you're looking at about a 2.5% management expense ratio, which you don't necessarily see. They're all the fees that are associated with managing the investments. I think the average is about 2.5%. So for every 100,000 you've got in super, it's costing you $2,500. If you've got
$50 a week, basically.
Yeah, exactly. Or if you've got 200,000 in your family in super, you're looking at $5,000 a year in fees that you don't necessarily see, not just the advisor fees, the actual fees to run the fund. If you have a self-managed super fund, you're generally looking at around $1,500 for a basic one. For $100,000, that's an MER of 1.5%. But if you actually have 200,000 in there, it's still a $1,500. Your costs don't rise exponentially with how much money you've got in there.
Dr. Steve, how does a self-managed super fund borrow for the purposes of, let's say, an investment property?
Well, the super fund in its own right can't borrow, but what it can do, it can invest in an instalment warrant. Now that instalment warrant, or a bare trust, whatever we like to call it, it becomes a lender. It borrows the money to buy an asset. The important thing is there has to be a line between the super fund and the instalment warrant. So if the investment does go bad, the lender has no entitlement on the assets of the super fund. There has to be a clear-cut line there.
So what you're saying is that the money in your super fund, in this case, a self-managed super fund,
Yep.
it's free of risk.
Well, there's risk in everything, but at the end of the day, it is protected from the balance of that loan. So if the loan cannot be repaid from the sale of a property or shares or whatever's in that instalment warrant, they cannot come back to the super fund assets and say, well, we want the balance. And that is the difference. There has to be a clear-cut line.
So it's non-recourse.
Correct, non-recourse.
Okay.
100%.
So we get our non-recourse loan set up,
Yep.
and we go out there and we buy an investment property. How do we go about that?
If you have a look at, let's just use a $350,000 property, a new property or newish property out in the suburbs. Okay. Self-managed super fund has $150,000 in cash. It needs to borrow $200,000. Okay. It now buys this property under the instalment warrant structure. You receive annually $15,000 a year rent after all the agent's costs. Say, is that a fair rental return on a property of that value?
A $350,000 property, 4 bedrooms in the burbs. You're looking at around 300 thereabouts.
Okay.
Yes.
All right, that sounds fair then. Well, the super contribution. This is a key point I want to get across. The super fund is actually invested in the instalment warrant, and it will receive the rent. The super fund will receive the rent. But this super fund also still keeps on receiving your 9% contributions into super. So instead of them going off into a managed super fund or an industry super fund somewhere, they end up going back into the Dallas super fund. Okay, so that money you're receiving, that 9% or salary sacrifice, I mean, we can put in up to $25,000 a year if we're aged less than 50, or $50,000 a year aged over the age of 50 if we're lucky enough to be able to do that.
So that's if. Let's just say the traditional situation of husband and wife having a self-managed super fund.
Yep.
So it's 25 each.
Yeah, exactly. I mean, or if they're over the age of 50 and they're lucky enough, they could put $100,000 in combined into this self-managed super fund. So in those situations, it's going to pay off debt really, really fast.
And the reason you'd put that sort of money in it if you're over that 50 years of age,
Yep.
is that when you turn 55, you've got transition retriment strategies
Yeah,
that
exactly.
you can take it out in one end, put it in the other, etc. But we'll worry about that at a later time.
Yeah, and I think, if you're trying to pay off a debt, like, let's say we're an average Australian and we pay our 31.5% tax, okay? So if I've got debt in my own name and I've got $10,000 worth of income, after I've paid tax, I've got $6,850 left over to pay that debt down with. If I have a debt in super, where I put my money into super, it's only taxed at 15%. So if I've borrowed to buy a property or shares or whatever we're going to invest in super, instead of having $6,850 or $5,000 if you're a top taxpayer, I only lose $1,500 in tax. So I can actually pay off my loans faster by putting it through superannuation.
You're watching Dollars with Sense. I'm talking to Dr. Stephen Enticott from CIA Tax. We'll see you after the break.